Hey guys, welcome back to today's video. I'm back with a new hair color and haircut. But you know what? You know who does not care about that? The market. That's right. The market does not care about your looks. And that's the good part actually about trading, because you are the boss and you are rewarded for your hard work and discipline and not for your looks. So today we're going to be talking about how to trade through bear markets. We're going to go through some recent corrections, how to handle corrections, and I'm going to explain also on the chart what to pay attention to when it comes to technical analysis. But before we start, guys, I want to announce one more time, we have here a free Telegram channel started a couple of days ago. You can find this on my website, so check this out. It's brand new, it's free. All you need to do is put your email and you're going to get the link. So let's start right now, and I would like to discuss with you guys some very important topics about the recent corrections, which were bigger than 5% since 2009. So after the financial crisis, we had a couple of corrections and we're going to go through them. We're going to take a quick look and see how those look like, and most importantly, how long those lasted and what is it important when it comes to trading through corrections. So we see here the S&P 500 corrections, again bigger than 5% since March 2009, and this goes actually only until February 16. So we had after that a little bit more corrections around 12%, which were, of course, didn't last very long as well. We can discuss those as well on the chart. But as you can see here, starting with 2009, we have here the days, how long those corrections lasted. We have the S&P high and low and the decline. So for us, very important for today, going into this video, is the days and the decline of the S&P 500. So we have here 5%, 5.5% correction, 7 days. We have 9.1%, 26 days. And if you go back up, we're trying to find the longest correction, which is, of course, deepest and longest correction in the past. And we see here that's 2011 was the first one, which lasted 155 days, and it was 21.6%. So again, if you look back, that's the past, more than 10 years here, and you don't see bigger, longer corrections. So every time the market corrects, normally what happens is it bounces back up in a matter of couple months. So you don't see long corrections very often in the past 10-12 years. And you see here, going further higher, we see 63 days, 8.9 corrections. You have here 12.5% correction, 96 days in 2014. 2015 we have 100 days, which was 14.5%, and I remember 2018 as well, we had a little bit bigger correction, 20%, which lasted around 3 months, which is 96 days. So what I'm trying to explain here, guys, is that you don't see a lot of those corrections, and even if you see, first of all, corrections like that, they don't last long. And if we go now in the recent history, 2018, the correction happened actually because Fed started increasing the interest rates. And this caused, of course, bigger correction and longer correction. It lasted much longer than normally. And that's very important, because having those numbers, you have to identify your edge. So you have to know on what side are you when the Fed is increasing rates or decreasing rates and printing money. And that's the most important thing when it comes to trading. It's all about interest rates when it comes to buying or selling, being short or having a lot of positions in your portfolio. One of the most important key factors is money being printed? Do we have low interest rates, or is Fed going to increase the interest rates? That's why until now, actually, I've been more on the long side, focused to catch some of those, pullbacks on the long side, trying to long some growth stocks, because those are been running a lot, especially with low interest rates. Those tech stocks, all those growth stocks, they tend to make 100, 200, 300%. So that's a lot, and that's why I've been focused a lot recently on the long side. Now the market is changing. Now we have a little bit different situation. We have, first of all, inflation. We have very, very high inflation. If we look back in the past 30 years, one of the highest inflation so far, what we have seen. We have Fed trying to increase rates, thinking about faster increasing rates, trying to, correct some of this inflation, which is, in my opinion, not going to happen. People are getting nervous. We have this war in the Ukraine and so forth. So the market is not what it was last year or 2 years ago. And, having that in my mind, I am personally looking now at the market, looking for some short opportunities instead of holding to long positions, instead of looking to buy in a bear market. So when it comes to trading, again, first you need to identify what is the current monetary policy, what is Fed doing, and then from there you can go based on the S&P 500 on the chart, identify your key levels on the daily chart, and identify the direction which you want to trade. That's the so-called top-down approach which I'm using, which means I start with the big picture and narrow it down and find from there individual stocks which are good to trade. So that's the key factor here in my strategy, what I'm using. Now, looking at that and knowing that we have now different situation, this means we have on the S&P 500 12% correction so far, and it means that we have much more room to the downside. Again, 2018 we saw 20% correction, so we have at least 8% more, if not more, to the downside. And we're gonna check out the chart and we're going to see why I personally think that the market is going to continue to go lower and how can you trade on the short side. I know some of you guys are used to trading on the long side and you probably don't even have an account for trading on the short side, but I'm going to show you today different strategies which you can use for your portfolio to hedge if you still have a lot of long positions, to hedge your long positions and also to profit in bear markets like that. And you know what? The good thing, guys, is that you don't even need to be a short seller. You don't need to approve your account for short selling. There are strategies which you can buy the inverse bear ETF where you are long, but you're long a bear asset. So I'm going to explain this in detail now. Let's take a look at the current levels on the market and situation and how can you go from there. And also I would like to explain my recent trade on AMD, which I did on Friday, which worked actually very well. Okay, so let's start. We have here, that's a stock which I'm watching too short. We have here the S&P 500. I would like to start with the futures. So that's the ES. And we saw pretty decent pullback and drop here. We've been going, up, and we have here a little bit of a correction. If I zoom out, we're going to see also a little bit of correction in the past as well. Let's check out the 3-year chart. So that's the 3-year daily chart. You see back here we had actually also a little bit of a deeper correction. We had here a tiny bit of a correction, but nothing was compared to this selling. So if you look at the candlesticks, you should be able to realize with your eyes this is much more volatility, much more selling is happening. To the downside is always faster, a lot of range. So all those candles are big white candles. They're not compared like it was here, very easy to trade. Everything started with a distribution cycle back here where you see choppiness, upside down price action, breaking of support zones, and then continuing lower. Now what happened last week is for me here key, guys, very important. We bounced off this decent support zone 4,261, made some reversal candles, which means we have here buyers stepping in, trying to hold those lows, trying to buy the price at this point. And this was actually a long signal showing us that there is enough buyers interest in buying those dips. and we saw this bounce above the 200 EMA, pull back for a couple of days, but you see all those candles. Again, you see the wicks on the candles, which means there are still some buyers trying to hold this support zone, which is the breakout zone back here. And actually everyone, including myself, was thinking, this looks like it's going to continue higher. That was the buy signal here. It looks like a breakout. We might continue higher. And then all of a sudden last week, CPI data came out. And what you see here, that's key, guys, is this big red candle, big bearish engulfing candle, which is bigger than the previous candle, closed very, very weak. So this is a failed breakout setup. If you see that, that's a very bearish sign, especially in a very uncertain situation like right now, what we have right now with inflation, interest rates, war, and so forth. So this bearish engulfing candle was for me a signal this is going to continue lower. And what I did here in my case is I started closing a lot of my long positions break even and started opening some short positions. So one of the short positions which I opened was AMD. Actually, I am long-term holding AMD, but you know, for a shorter term trade, I saw these lower lows, lower highs, and I saw how the price action has been very bearish actually back here. And again, I was buying actually some of AMD around this zone, but then I saw this reversal. Same thing what we see on the S&P. Remember, you start with the big picture, you start with the indices. You want to know what's happening on the big picture before you go to those individual stocks. So you're following, or this is at least what I am doing, I'm following the top-down approach, starting with the bigger picture. Seeing here as well, failed breakout, red candle. First of all, we have a downtrend here, and then I went short around this zone, and this was a 10% drop. I catch this whole drop, actually closed my position, and you know, actually could have still have some left in case it continues lower, but that was a huge drop. And this is how you can analyze the market, starting with the overall situation, big picture, narrowing it down and finding individual stocks to short. Now, I know, again, some of you guys don't have the ability to short stocks. Maybe you don't have the accounts for that. Regardless of what it is, you can go to some of those reversed triple ETFs. So, for example, a good example, if you, let's say, if you want to short the tech sector, then you can check out the SQQ. And this is the reversed ETF. So you see it is designed to go down. Every time the tech sector goes up, this one goes down. So it's doing the opposite. Now, if you don't have an account to short, or you don't know how to short sell, what you can do is you can definitely start looking for some buy opportunities here. So if you buy this, this means you're shorting the tech sector, is the opposite. And we see here, this is an uptrend, which is, again, the opposite. We have on the NASDAQ a downtrend, so this represents exactly that. And if you cannot short, you can definitely buy around this zone and look for a continuation higher. Now, something I want to mention here, those are double, triple ETFs. Those are rebalanced in order to be able to get to double or triple gains compared to the index. And you might see some differences which could have not the best effect on your portfolio. So just be aware of that when you're trading those. Be aware they're not meant to be long-term holds. They're meant more for short-term trading. But if you know that, that's okay. You can definitely catch a couple of days move with those. So that's another good way. If you don't have the ability to short sell, you can use some of those. Another example is TZA, which is the same thing. That represents actually here the small cap ETF, IWM, and it's same thing, designed to go down, and by the time it starts to go up, means this is the opposite of the Russell 2000. If the Russell goes up, this one goes down. So if this goes up, means the Russell goes down. So if you want to short it, this is also a great instrument to use. Again, guys, this is not an investment advice. This is something what I personally use and what I'm sharing with you. Another example, of course, if you have an account for that, you can definitely use the futures, the micro futures, for example, M and Q for the NASDAQ, and you can short those with smaller size or some of the stocks. So that's what I wanted to share with you guys, how to short sell, what to look for in a bear market, how to start with the big picture, knowing your edge in a bear market, knowing that this might be over quicker than we think, and just being able to identify opportunities but not hold on for too long, because as I showed at the beginning, bear markets does not happen a lot and they don't last normally, especially not in the last couple of years, they don't last very long. So that's something I wanted to share with you. I hope you guys find this video helpful, and if that's the case, I hope you support my channel, give me a thumbnail and subscribe to my channel, and I'm looking forward to see you in my new channel. Thank you so much and bye.